We all are going to always work for money because that's what we do to make money. But eventually, when you work for money, you follow the 6 laws of wealth, or you go through the process. What's going to happen is money's going to start working for you. Colleen said she got 2 checks just today that showed up in the mail. That's because of her money working for her. Now that sounds a lot more fun than going and trading hours for dollars or working for money the rest of your life. All right, welcome back to another week of Wealth Webinar. Today is going to be a good one, folks, because with everything going on in the markets, with the storm, I would say, is upon us, with the markets being about as turbulent as they can be, first we need to understand where we've been, and then we're going to talk about where we're going, and how we're going to do that is I'm going to walk you through a very quick timeline of all the recessionary periods since the Great Depression, because it's important, again, to understand why certain events happen, to then bring us to the current time of where we're at, and then myself, Mr. Snaggy, and our trader, Sodi, we're going to talk to you about what you should be doing right now to prepare for this and how to get ready. So let's dive in. I'm going to share my screen here. But hey, before we get started real quick, everybody, how many of you are here for the first time? And in the chat, what I'd like you to do is just put I. So AYE or I before we get rolling. Just want to see how many people we have for the first time. And if this is your first time, this is nothing new that we have technology problems. It's actually normal. So don't think we don't know how to use it. We have probably one of the more elaborate setups here. We just haven't yet figured out how to use this sucker. So let's dive into this, all right? Recession is what's coming, but let's just take a trip through history so you understand exactly where we've been. We all know about the Great Depression. Okay, the Great Depression started August 1929. That was the technical indicators of when the Depression actually kicked in. And it went all the way to March of 1933. That was 3 years and 7 months of pure economic chaos. The peak unemployment was one of the highest ever, 24.9, only rivaled by the pandemic, and the GDP decline was 26.7. It was quite a bad period of time. We've only read about it. No one on this Zoom has ever lived through the Great Depression, and if you have, then you're doing something right. Please come on as a guest and teach us what to eat and how to make it that long. But a couple of the things that really led to this are very similar things to what are happening today. So a lot of the different things that were going on in the economy are just like today. It was a long period of time before the Great Depression. There was the roaring 20s. Everybody was making money. The stock market was booming. Everybody was saying it's going to the moon. They had the stock pickers, very much like today. So then we move on from the Great Depression and we move on to the next period. So what we're going to do is we're going to quickly just walk through. This is the recession of 1937 to 1938. This one happened from May of 37 to June of 38, so it was a short one. 1 year, 1 month. Peak unemployment was 19%. GDP decline was 18.2. So this one's considered very minor compared to the Great Depression, but otherwise it was amongst one of the worst recessions in the 20th century. So it's worth talking about. And not only that, this is where they really started playing with fiscal policy, which resulted in an attempt to balance the budget. And we all know the New Deal was created out of the Great Depression. And they were spending, the tight monetary policy of the Federal Reserve. There's a lot of things happening. Remember, the Federal Reserve came to be in 1913. If we go before the Federal Reserve, things were very different than they are in this. So we can see that was the 1930s, but then we go to the 1945s. Now, as we get into this time frame, some of you either may have grandparents, great-grandparents, or maybe even some of you were born or lived during this period. This one was another really short-term one. It went from February of 45 to October of 45. It was only 8 months, one of the shortest. Okay, peak unemployment was 5.2. GDP decline was 12.7. And this one primarily was the decline in government spending at the end of World War II. That led to an enormous drop in gross domestic product. I want you to parallel some of these different things that happened then to what's happening now, because there's so many similarities to each one of these periods as to what's happening during that period and what's happening now. So they came off of a period where the war allowed them to spend unbelievable money and make crazy amount of product for the war. I mean, companies were making tanks and jeeps and all sorts of things to support the war. When the war was coming to an end, that meant all those goods and services were no longer needed, and that's what led to this one. As we go into the recession of 1949, this one was another 11-month recession. Now, we look at this and we say 11 months, oh, that's short. We could do that. But if you lived through this period, it wouldn't have been fun. So I don't care if it's 2 months, 8 months, 12 months, years. Each one of these periods was very difficult to live through. November of 48 to October of 49, peak unemployment, 7.9. And this one was a brief economic downturn, and the time expected was much worse, perhaps I'm just reading some notes, influenced by a poor economy in their recent lifetimes, the Great Depression and then all the recessions that followed. 1953s, so we all remember the 50s, or we should know something about the 50s. So 53 to 54, 10 months, unemployment was 6.1 and GDP declined 2.6. This was after the Korea War. It was an inflationary period. More funds were transferred to national security. And in 1951, the Federal Reserve basically reasserted its independence from the U.S. So you got to remember the Federal Reserve and the U.S. government are two different things. And this one also changed the monetary policy to be more restrictive because of fears of further inflation. So again, largely due to inflation and a bubble forming. Does that sound familiar to today? Again, just looking for very little similarities. 1957 to 1958, 8 months, 7.5%. So you can see much lower than Great Depression, but monetary policy was tightened during the 2 years preceding 1957. I want you to understand, monetary policy was tightened. That is exactly what's happening today. Monetary policy was very loose. They printed $5.1 trillion. Monetary policy is now being tightened, raising interest rates, unwinding the balance sheet. All those things are resulting in very similar situations to these other recessions. I mean, the 60s were a darn cool time. If you really look at it, a lot of the best music came out of this period. But the budget balance resulted in a change in budget surplus, and you had this little bit of a recession here. 1960 to 1961. The other thing, too, if you were really looking at this, folks, you can see the time frames in between each of these recessions. If we average this out, you get about 7 years, and that's normal, 5 to 7 years. It's a short-term debt cycle, 5 to 7 years. Every 5 to 7 years, you have a recessionary period, only changed up till recently with modern monetary theory. So this one here, 60 to 61, another doozy, but it was, again, 10 months. So 10 months, and this was President John F. Kennedy was inaugurated, and there's a lot of things that were happening here. But again, all based on Federal Reserve raising interest rates in 1959. Do you see this? The Federal Reserve, every time they've done what they are doing today, raising interest rates, unwinding the balance sheet, has resulted in a recession. Every single time except for one. I'm just trying to show you that what we're going through today is not very different than what happened back then. Here we go. Recession of 1973 to skipping through one. Recession of 1973 to 1975. I skipped the last one. But you can see 1 year, 4 months. Peak unemployment 9%. GDP decline 3.2. This one here, 1973, oil crisis. The quadrupling of oil prices by OPEC. How's gas looking these days, folks? Is it going up or going down? Seems to be going up. Gas here in New York is almost $5.50 a gallon. I know parts of the country are what, almost $9-10 bucks? But right here, 1973, 1974 stock crash, largely due to stagflation, which is absolutely where we're going to be headed if they keep doing what they're doing, and the oil crisis. Well, the Russia-Ukraine war is creating something of an oil crisis. Now that the EU largely has said that they're going to stop buying, Russia has just said, we'll just find other people to buy our oil. Nonetheless, we are going to have shortages of oil. That's a fact, and that's what led to this recession. Here we go. Okay, this one here, we got the recession of the 1980s. So January 1980 to July of 1980. This one was a short recession, 6 months, but still wasn't very fun going through it. The recession began as the Federal Reserve under Paul Volcker raised interest rates dramatically to fight the inflation of the 1970s. All I'm trying to show you is, like, no matter how you look at this, no matter how you shape this thing up, it's always the same reasons. And the same reasons are the reasons that are happening right now. So, I mean, we all know that this is coming, but I'm just trying to fortify, like, it's happened every other time, so get used to it. This is nothing new. All right, so keep going here. Early 1990s recession. Okay, July 1990 to March 1991. There you go. This one was a doozy as well. We all remember this period of time. Peak unemployment, 7.8. GDP decline, 1.4. Moving on to this one, the early 2000s recession. We all remember this. Okay, if some of you, maybe some of you are too young to remember this, but almost every one of you on this would remember the dot-com crash. Okay, March of 2001 to November, and that's a typo, or no, actually it's not, November of 2001, 8 months, peak unemployment. This one was this was a terrible, terrible period of time. Absolutely horrible in terms of economic growth, horrible in terms of the amount of money. In the 90s, I want to be clear too, in the 1990s, they were the longest period of economic growth in American history. Okay, the 90s were. So up to that point, the collapse right here, the dot-com collapse, was because of tech. And I remember watching the football game, the Super Bowl, and I remember watching all the commercials as a kid, because I was still a kid around this time. Not a kid, but I was a teenager. And I remember during this period watching the Super Bowl with my dad and thinking, who are all these companies? Every company that bought Super Bowl ads, they were all tech companies. Today, I bet you 90+% of those companies on those Super Bowl ads during that period are no longer in existence. The ones that are, the Amazons and the other ones that you also well know, they were the survivors of the dot-com crash. And the dot-com crash also, you know, a lot of you remember this economic recession because of the September 11th attacks. Even I do. I remember exactly where I was at, what I was doing, except for what I was wearing, I don't remember, when that plane hit the tower. And that brought a decade of growth to an end very quickly, and it resulted in a terrible 3 years. I remember this is the period of time when I actually entered Wall Street. I had to get a job because being a shop owner, I own skateboard, snowboard shops, my business took a hit of 30+%. I couldn't pay my car payment. I couldn't do the things I was used to doing. I had to get a job. So one thing that came out of this one, the early 2000s recession, is for me, this is when I entered Wall Street. It was kind of a weird time to enter because I entered Wall Street at a time when everybody had just gone through a recession. So it was pretty interesting trying to actually talk to people about financial products when they had literally just gone through a recession. It was not very fun. And then that brings me up to one that I think you all remember, the Great Recession, probably the closest the United States has ever come to a complete financial collapse. Many of you remember this as the subprime mortgage crisis. It was only a 10% peak unemployment, which compared to the Great Depression was really nothing. Compared to what happened during the pandemic wasn't much at all. But so much happened here. It was the global financial crisis. Oil and food prices soared. I want to repeat that. Oil and food prices soared, just like they are today. This was largely created due to the subprimes, which was all affected mostly on real estate, but it also collapsed many of the banks that we used to think were the too big to fail. Bear Stearns, Fannie Mae, Freddie Mac, Lehman Brothers, AIG. I want to be clear, AIG is an insurance company, but not a mutually owned. They are a publicly traded. The mutuals, the New York Lifes, the Mass Mutuals, the Lafayettes, those companies did really well during this Great Recession because they were prepared for it. They were positioned for it. Banks, all the ones that I just mentioned, were not. And this is interesting, and Stephen and Sodi, I want you to really kind of hone in on this. The government acted very quickly. They had to. It was so close to a complete failure of the entire U.S. economy that when they reacted, it was an unprecedented amount. Now get a load of these numbers. This is 2008, folks, not really that long ago. $700 billion bank bailout. $700 billion, and then another $787 billion in financial stimulus packages. Add those up. What does that work out to be? A little about $1.5 trillion? $1.5 trillion in 2008 was printed to bail out what would be the biggest failure of the banking system and the U.S. economy in modern day history, actually all the way back to the Great Depression, and they printed 1.5. It was unprecedented. You do remember just a short couple of years ago they printed 5.1 trillion and they're still going. Just trying to point out the obvious here, okay? And then let's kind of move on. We'll hit the end of that, and let me stop sharing that. Bingo. All right. So after that one, we went into what we just witnessed is the COVID pandemic. Higher unemployment numbers than what you saw. The government printed $5.1 trillion, reduced interest rates to zero, pretty close to zero. The real rates were negatives. And all the things that you just saw happening all began right there. So the government printed $1.5 trillion during 2008, another $5.1 trillion during the pandemic, and now here we are today. So the real question comes to be is, what's next? Like, and what do we do? All I did that for, and I missed a lot of the details, and I apologize, but the reason I went through that is just to show you the similarities. Fed raising rates, Fed unwinding the balance sheet, which I didn't really get too deep into, but there was several periods where the Fed was starting to sell off some of the bonds that they had basically acquired by trading dollars for bonds, because that's all it is. It's that the U.S. government needs the money for the stimulus packages and everything else. The Fed and the Treasury prints the money, the Fed controls the supply, and they exchange the dollars printed at the Treasury with the U.S. government for U.S. government debt, called Treasury bonds. And that's why right now, to date, they have, God, what do they got, 9.8, probably, it's tremendous. It's almost $10 trillion in debt they hold on their balance sheet. They're going to start unwinding $95 billion. Just so you know, if interest rates don't crash the economy, that certainly will. So today is what, June 1st. We're all going to enjoy probably the last summer before we enter some really dark times. Dark times that could resemble the Great Depression or any one of those recessionary periods, or a combination and a mix-up, a mashup of all of them. And the reason this thing's going to be so bad is because we have literally had a government and the Fed kick the can for so long, print money under this new modern monetary theory of economics, and literally think that they can change the dynamics of what's going to happen. And hey, so far it's worked. So a lot of people are like, well, can't they do it again? Well, I think their actions are showing they're not going to. So let's dive in, Sodi. Real quick, we talk a lot about this. So what are your takes? Because I know me and you differ a lot, which is good. We shouldn't all have the same opinions. Me and Steven, we think the same. We're just like, the shit's going down. It's going down like the Titanic, but probably faster. Like, that's how we think. But Sodi, you're a little different in the way you look at this. Now, the other thing I want to point out is I'm older. I've been through a recession as an advisor. I've been through a couple of recessions as I'm living. This would be what I would call your first real parade that you're going to go through. But what is your take? I want to hear kind of how you're looking at this. And I know you're a professional trader, so I'll stop talking right after this, but make sure you understand that the people we're talking to, the 123 that we have on here, they're not professional traders for the most part. So let's keep it like at like a 5th to 10th grade level.
Sweet. So yeah, this will be actually the second one, because most people, actually it will be third, because people count COVID as one. And then I just started trading towards the end of the recession. I think I was 13 or 12. I'm not sure. But yeah, so that's when I started. So I remember watching all of that initially. And when all the documentaries and movies came out after, I think then people really understood what happened. But I remember hearing a lot of people in that recession saying, hey, we called it, we knew this, and all that stuff. But I remember reading what they wrote, and then remember looking into the research when it actually came out, and they were nowhere near it. It's like, that cry wolf, and then it was literally a lot of people fabricating stuff or just saying why. Like, they're just like, no, it's gonna happen. And just because something happened doesn't make you right. It just means you could have gotten lucky. But so before I explain where Chris and I differ and why we differ, let me give you a couple things for everybody to understand of how I get to where I am, of my conclusion and analysis. Number one theory for me, number one point is the economy and the stock market are different things, because not everything in the economy is reflected on the stock market, because a lot of mom and pop shops, small, medium-sized businesses, and quite a few big businesses are not on the stock exchange. So the stock prices can be close reflective of the economy, but they are not mirror images. So they are two different things. The Fed is responsible for the economy. It can do its best to facilitate cash into the stock market, or buy treasury bonds. And maybe in the future, who knows, with what we're going to head to, where Chris and I align in our opinions, There will be a time where I think the Fed will be a buyer and holder of actual equities in the market. Now, what that would look like in yield, I don't know, but that's for the future to worry. That's point one. Point two, my analysis is more based on price action. It's based on something called Elliott wave. It's a very common theory out there. Not a lot of people understand it correctly. So if you read about it, you get interested in it, I'll put my email, shoot me an email, we'll talk more, I'll help you find the right resources. It is a very complex theory, but it is based on fractals and metaphysics. Now, if we look at nature and all that stuff, as you dive into Elliott wave, you'll either agree with it or you won't. It's just that simple. You'll either be like, this makes sense, or you will say, this is absolute garbage. Either way, it works. Either way, it's fine. It's what works for you. So that's number two. And number three are astrocycles. So I'm a big believer of, again, physics and just astrophysics and the influence planetary motions and things like that have. So if you do your research into that, again, happy to help anybody who gets interested into that stuff. But if you do your research into it, you will see a lot of stuff around it. Now, I'm not going to give away anything about it because, just other reasons. But if you do your research into astrocycles and things, you will find enough information out there to either make you curious to look at it or just completely disregard it as hogwash. Either way, it's okay. But those are some of the things that I will be, that I will add to my analysis. That's how I get to the conclusion. So now with Elliott wave, what's happening here? Now, 2.5 years ago, about 2020, when Chris and I first met, we talked, and we talked about the same conversation then, and we still talk about the same conversation now. Chris said he was bearish, and I told him I was bullish, and we differed in opinions then, and we talked about it. And I told Chris one thing. I was like, somewhere around 2022 end, maybe going into 2023, this thing will come to a culmination. And I still stand by that timeline. Back then, and I'll share my screen, I'll show you some charts here in a minute. We are, since the Great Depression to now, we have been in a 93, 95 year bull cycle. Now I'm talking about a cycle. I'm not talking about a market. I'm not calling this one long bull. I'm saying a bull cycle. In a cycle, things go up and down as they overall go up. That's what a cycle is. If you've read anything from Ray Dalio, you'll see he's a big proponent about large debt cycles and small debt cycles. But within a large cycle, there's small cycles. So since the Great Depression to now, we've been in what's been a bull cycle. In that, all the recessions that Chris has mentioned, from 37 to 87's crash to 2001 to 2009, they're all part of it. They're all part of it. And that's why we've bounced back the way we have. Now, I'm not disregarding the Fed and everything, but for my analysis, I have to look at purely price. The news around it, comes later, is what I'm trying to say. Now, if you look at an earnings report for a company, and let's say Apple is selling everything at a phenomenal price and everything's doing great, but the stock tanks, it doesn't make technically any sense why the stock is tanking. But the news will find something to say, oh, it's because the CEO sneezed. That's why the stock tanked, because people think the CEO is sick. So the news can be created around the sentiment, but the sentiment can't be fake. It is what it is. And it goes through cycles. When it's extremely bearish, when everybody's bearish, you'll see usually market bottoms are there. When everybody's extremely bullish, that's when usually market tops are there. Sentiment is king. So anyway, and then with going back to that, the price action is still in late. With our current predictions, and I've talked to a couple of people about this, and in January of this year was the very first time I was bearish. And we all know what happened. I was bearish for the first time. I said my ideal target was 4,000. We went below that to almost 3,800. I didn't trade any of that, but up to my price action is where we started going reversing long. And now, because I said January bearish, we're back bullish. I think there's one last leg left in this market that takes us back to new highs, even higher. I'll share some charts here. Let me actually just do that, see if I can, while I'm talking, so people can see.
Yeah, and one person was asking, Jim Collins was asking if you could show where you think we're at on the Elliott wave.
Yeah, absolutely. Let me do that. So let me make two things. Okay, hopefully everybody can see this chart. So I want to say one thing first. This is not my chart. This is not something that I put together. This is Elliott Wave Traders charts. If you guys get interested in it, I'm happy to share the resources. But for anything Elliott Wave related, I think these are the go-to people. They have taken the most perfect approach to it, and there's no nonsense around it. Anyway, so on the left side, you can see kind of our 2009 bottoming. And since then, we can see one leg up straight. And you can actually, let me get some annotations. I can circle things around for people to see it easier. This was 2009. This is COVID. And this is where we currently are. So now this is a couple days old, I believe. Anyway, so this chart is kind of showing the last wave cycle because it goes 5 waves. So this is how Elliott Wave goes. It goes 1 up, 2 down, 3 up, 4 down, 5 up. Okay, this is 1 wave. This overall is considered to be 1 wave. That's where the complications begin. That's where things can become a little bit tricky to analyze and understand. That's why it's important to do your analysis properly with these things. In this case, we have now this. This needs to be altered. This may not be a 3 and 4. We think there's one more leg up in this market because that would be the final cycle of this actual bull market from 1934. Sorry. So our price target for that, and I'm calling this right now, and I've called this before, is first would be new all-time highs. So that's what I would be looking for. I would be looking for your 4,800 plus first. We're already at 42 something and back down to 4190. Next, we would be looking for 5,000. After that, we would be looking for 5,200, and then lastly, 5,500. Okay, so those are like the few price targets that we're looking at initially to kind of go along. Because again, so this is a chart that I put together, and this is a chart I've been sharing for a long time. This is SPX, the market. So there's a lot of stuff here. You can already see I've drawn some lines somewhere around January, which is over here, before our first drop around 4,800, 4,700, this range. We've been talking about, a 4,000 target, which is all the way around here. So this is the first time, and around 4,000 is when I started going long again, that we are like, okay, yeah, the bottom may be in the bottom, and based on a bunch of astro cycles, our dates were either May 14th or May 20th. If you look currently, the lowest that's there, okay, is on May 20th. So we could go back down, I don't know, but as of now, the low has been in for this market. Our first target right now is 4,300. Then we're talking about 45, 50, and then 48. So again, as we go, like I showed you the Elliott Wave chart, this is a broken down daily chart. So this is what we are using on our day-to-day to analyze the market. So again, at this point, at these 2 lows, the last couple of weeks, if you ever read the news and anything, you would literally be seeing everything tanking, from cryptocurrencies to bonds. Everything was down. The sentiment was literally like blood in the streets, and pretty much close to what we saw COVID times. Pretty much close to what we in 2 years saw around COVID times. And then the market rallied. Everybody's selling into these rallies. Everywhere that I've seen, everybody is of the mindset that this is not a really sustained rally. It's just where people are going to keep dumping out. And I think this is what's going to catch people by surprise. I think this is what's going to catch people by surprise when it continues to rally through. Now, I don't think this is a, buy all kind of a thing, because again, we are ending the bull market. And this is where I think Chris and I will eventually align up in analysis, is as this cycle. Now, this is, again, nothing goes straight up, nothing comes straight down. As we start to go up, we might go up, come back down, retrace. Remember the line chart that I showed. Here we go. So it could very much be like something like this. So again, there's a couple of ways this wave can create itself, but we have price targets, and we are targeting that price in different ways how we trade around it. Now, I think this is going to catch a lot of people by surprise, which is going to have a lot of people, have fear of missing out, FOMO, follow through in, and then that's going to continue pushing it higher. But the point is, at the end of this, and let me go back to this other Elliott chart. At the end of this, which I think is over here and not here, at the end of this, there is a proper bear market that unlike anything anybody has ever seen, because like I said, it's a 90-year bull market. Unless somebody was there, somebody in the age of 110 on plus would have actually lived through the bear market before this and remember the experience. And if they were a trader back then, they would know. But this is going to be something like we've never seen before. This is going to be something like, as a price analyst, as an Elliott wave trader, I can't tell you what the news will be. I can't tell you what the headlines will say. I can't tell you how people will react. I'm sure it's not going to be positive. I can't tell you will the dollar still be there. I can't tell you the news. I can't tell you this, what's going to be the headlines and things like that. What I can tell you is the price. If you can trade the price to those certain levels, there's an opportunity for you to make money, be profitable in any kind of market. But if you try to predict the news, if you try to predict the politics around it, if you try to blame a political party, if you're trying to blame, again, if you're saying it's the Fed's fault or it's the Treasury's fault, you're going to waste your time in that drop. I'm talking about that drop when it comes. What I'm talking about is how to prepare yourself for that. How can you prepare yourself for that? And that's the thing. We said the bottom was in, we're finally bullish. We have certain price targets at which we will continue to take profits. And this is not an all-in market, like we're not buying individual stocks. I will show the trades in a second that we took. I think this is the last opportunity for a bull market. I think this is, and Chris and I talked about this in November or December 2020 when we first started working together. And I told him, I'm like, listen, when the time comes, which it will, because everything has its time, we will do something similar where we call it the yelling from the mountaintop is I think what I said. We will do something very similar for everybody out there that's looking to, has their retirement savings, or at least even if you have an advisor who may not be aware of that stuff, anybody that could protect your money if it's not under your control already, needs to know that, because you don't want to leave money sitting there, no matter how much you've made or how little you've made. If you're closing in on retirement, you could probably be looking at a 50-60% market decline that just isn't worth surviving. Because what happened in 2009, we saw like within 5 years, we were back to break even. We were back to all-time highs. This is not that market, folks. This is not that market. This is a bear market. This is a proper bear cycle is what I should say. Sorry, not a bear market, a bear cycle. So again, this is an opportunity one more time for people to buy into, to continue with this last leg of bull market. If you're risk averse, doesn't have to. It's not financial advice. It's, I'm just explaining what I would be doing here is buying in. If you're low on risk, you don't have to. You can just wait. But when the mountaintop comes, which it will, and we will be there yelling, there's no more buying opportunity for at least a good 4, 8, or maybe even 12 years. With what monetary policy is doing, with what the valuation of the dollar and things would be, there is no pretty scenario. And I'm not one to paint, pretty picture and try to tell you things will be fine. They won't be fine. They will not be okay. A lot of people, with inflation and everything, what it is, I wish I would know better of, what to do with the dollar. Like I've talked to Chris about this as well. We are looking into different places, different currencies, different kind of conversion, because I am worried about the banks. Again, with what happened in 2009, I'm worried that people are gonna get freaked out about what's happening to their money. There might be another cash run like there was in, because think about it, like if they printed $5.1 trillion in the last 2-3 years, how much of that money is in actual physical circulation? I believe, if I'm not wrong, the number was 15%. 15% of actual printed money, of actual money out there, is only in actual physical circulation. I could be wrong, don't quote me on this, but I don't know what the exact number around it is. It could be lower or higher, but it's not 100%. If everybody wanted their money, not everybody's going to get it, is the point. So not to paint a gloom and doom picture, but what we need to understand where Chris is, and how he explained about the Fed trying to curb interest rates and trying to manage inflation, trying to do all this stuff and failing to do so, will have its negative effect, will have that down effect. For me, it's just there is one more bull cycle, one more bull run left in this market before that happens. And when that happens, trust me, we'll be back here again because this we wanted to do to call in kind of the bottom for the market for now. But when that happens, it could be October, it could be November, it could be December, could be even March. It depends how things shape out. But whenever that happens, we will be back here yelling and shouting the same thing, that guys, get out. And if you're young, if you're starting out in the market, still wait. You'll have a better opportunity to buy in. But if you're somebody close to retirement who has a lot of money saved up, wants to enjoy their wealth, this is not something you're going to want to be a part of. And if you don't have control of your money, which by now, if you've been here a couple of times, you should know what I mean by that. The people that are in control of your money, you might have to take a stand against them and be like, no, I want out. Because what's coming is, if they don't know how to protect you against it properly with proper hedges, with proper puts that will at max maybe cost you 1 or 2%, yeah, you're at very massive risk if you're losing a lot of your wealth with that next crash. And it will. And again, I think we are, what I was before March 23 second quarter, I am probably now 2022 quarter 4. So I think we are closer to it now. Again, as things shape up, you'll hear from us. But when that time comes, trust me, we will be back here shouting about it and saying, that guys, it's time for you to get out. Are there any questions? I'm going to pull up the trades that we took.
Yeah, Stephen, you've been kind of following along with the chat, and I have been too. Jim Collins was just saying he doesn't see any FIBs on your chart. Do you use them or other indicators? And then William was wondering if he could get your contact info so we can have a discussion. So if you want to toss that in the chat so that everybody knows how to get a hold of you, and they can, folks, just so you know, Sodi runs 1010 trading. All of you have the ability to work with him and to kind of follow along with him. And one cool thing that came out of that is, Sodi, I don't really think we differ in our thoughts. I just think you're an eternal optimist and a trader at heart, and me, I'm just like, I don't want to, play with the monster, if you will, and trade into it. So I'm just preparing for the storm. So I think we're saying the same thing. You're just optimistic, and I'm just pessimistic, and that's really the biggest difference.
It's kind of actually funny because you're wearing a black T-shirt and I'm wearing a white T-shirt today.
How ironic.
No, but I think Chris's the presentation that Chris did, I think it's very, very to the point. Again, I don't know what the news is, but when there is so much correlation with what Fed does and things like that, and you look at it, it's a good indicator. And if you are low risk, it is probably a good idea for you to stay out. It is an opportunity, great, but you need to know how to trade it. You need to know somebody who's doing it, so you do it as well. You don't want to be stuck there knowing, oh, wait, the market's at all-time high. What do I do now? Do I get out? Do I hold? But you need to know that. But if you stay out, you're going to be just as fine, because again, what's coming is actually very, very not pretty. And it's something you need to be aware of, that, okay, I'd rather just stay out of it. And then fibs.
Yeah, the technical indicators, which we've talked
Jim,
about numerous times.
So Jim, I do, if on the other chart, again, that's not my charts, I don't really want to go there, but the guys who do this, they do a phenomenal job. Every move is fib based. So how they do the structure is basically so if you look into Elliott wave, I don't want to get very technical here. If you look into Elliott wave, every single wave retraces a certain part of the previous wave. So that's where the fibs come in handy. So when you get a wave 1, you have fibs that tell you a retracement to a wave 2, and those allow you to predict a wave 3 extension. So that's how fibs come into Elliott wave. There's a lot of different ways people do it, but if you look into some basic Elliott wave structures, I think understanding the structure is first crucial, then adding fibs for Elliott wave is. But other than that, I don't use fibs for analysis. I use fibs for trading. I use fibs as position profit taking measures. And then if you guys see on your screen right now, these are the trades for, so again, because I told you, you want to keep it simple. You don't want to complicate things. We only trade SPX now. We've completely switched to SPX because it is also a tax advantage product, if I'm not wrong. It has great price action. It has contracts that go from anywhere from $30,000 to $300 that you can still make money on. And that's been our entire strategy now, just trading this. Sometimes most of these can be day trades because we get the trade in the day and by the afternoon it's out. And there's plenty of ways now people can do that. But that's all we do. And you can always carry forward trades. And these are our past months returns for this this strategy specifically, and that's what we're going to continue to trade. We're going to start adding size to it, but that's what we do. And if you are interested in like learning more about these kind of trades and everything, shoot me an email, because our trading ideas room that we have, you guys are more than welcome to join. We do a week free trial for that. But yeah, it's I think it's going to be 150 starting next week or something. But since you guys are here, if you want to just shoot me an email saying, hey, waitlist me, or I want to be there, we'll save you at the current price, which is like 96 bucks, 96 something. I'm not sure, but yeah, it's somewhere around 96 $100. But yeah, it will raise to 150 next week. So since we are here, since you guys are here as well, but yeah, if you are having interest or anything, shoot me an email, say waitlist me, and I'll make sure that we save you a seat on that price. And he will send you that coupon. But yeah, and then we do a week trial as well if you guys want to see that. But yeah, so I like I said, you need to keep it simple. You don't want to complicate things. That's what we do. We have maybe 3 or 4 individual names in holdings, which as this bull cycle culminates, we will be getting out of, and that's it for that. That is it for that. Like, we will only be trading SPX. We will only be intraday swing trading SPX, because that will be the best brand out there. And going back to oil, that's one thing that I didn't want to talk about right now, because again, this is time where even my analysis conflicts. Elliott Wave tells that oil is going to go higher. Astrocycle says the oil's going to there's going to be a bear market in oil. And then, so since there's 2 different angles to it, and you look at the news with what Russia is coming to do, there will be a shortage for Western countries for oil, but the Eastern countries are benefiting from it. Like, I know, because I spoke to my folks in India, and oil's fine there because India is a buyer from Russia, so they're fine. It doesn't make a big deal for them. So it is an interesting tug of war that I'm waiting to see how it plays out for oil. So that's why I don't have any oil positions. I'm not long or short oil. I want to see how it plays out. And I think somebody asked about dollar. Again, dollar as a price will fluctuate. It could go lower, it could go higher. The overall question is, how much is your dollar worth? And if you look at just ever since we got taken off the gold standard, $1 to back then is worth, I think it was 12 cents or 6 cents today. So I mean, it can go lower. I don't know how much lower it's going to go, but so yeah, so you need to trade what you know. You need not trade, or stay away from what you don't. And when I have conflicts like this with my analysis, I stay out of it. SPX is the only thing we're trading at that moment.
There you go. This is what happened to the dollar. So Fed Reserve comes out.
There you go.
1913, 100's worth 100. 100's purchasing power is 100. I only have it till 2019, and that's before they printed 5.1 trillion. But
Yeah.
$100 purchasing power in 2019 was 387. What is it today? I don't even know.
Yeah, I'll have to look it up. But that's the point, So again, it's important to also just protect your money, folks. Like, some of you might have advisors or whatever, but you guys need to be in conversation. You need to have a plan, and if you decide to stay through it, that's okay too. But you need to have a plan. And if you can't have some concrete price actions, concrete plans of, hey, at this time, this is what I will do to my money, then you're really not in control of your money. Somebody said, why not trade the Dow versus the SPX? So I like SPX more because it is the most liquid options contract out there. So let me make something clear. You can't buy and sell a share of SPX. You can only trade options on it. You can trade SPY if that's cheaper. You can trade SPY. That's perfectly fine. You can, if you want more leverage than options, you can trade SPXL, which is a triple leverage ETF. So when SPX moves $1, SPXL will move 3. That's like their conversion. So that's another thing that you can trade options on. But I guess when you guys will get the trial, you get to see how it looks and everything. So there's different things to trade. SPX is just more cleaner, more smoother for me to trade personally. I know it is. It has, what's his name? Tax advantages. Sorry, I forgot the word. Again, don't quote me on those, but I know it has some kind of better advantages to it. So I'd rather just trade one thing that I can consistently understand and have a system that works on than try to hit every single ball out there. So only options, no futures contract. Jim, that's a great question. If you are a futures trader, let me know. Shoot me an email again, because and this is something that I wanted to, if we have a little bit of time. So folks, you can trade your own money. You can trade options. You can follow the strategy. The same strategy works on futures. I also send futures alerts. So we will do ES and Q alerts. We are working, because there are so many There's so many opportunities out there for people to, pass evaluations and trade. So we're going to teach you how to do that. We're going to teach you how to pass an eval, get your own funded account, and then be able to trade there. So we'll talk more about that eventually when we get there. But if you email me, definitely shoot me an email. And if you are interested in any Elliott wave or anything, and you want to save a spot, definitely email me. I will make sure that you get one. I'll also probably throw in a trial as well. But I'll send you more information about our futures as well, because our futures trading for, it's part of the same thing. So it doesn't matter if you trade options or futures, it's all included in the same deal. But it will show you how to pass those evals and how to do that stuff. It'll just help you with that. Jim, I do futures and forex due to leverage during these days. Makes sense. I understand. I trade futures myself as well, but I trade them in the eval side. Forex, I haven't traded in. My God, I want to say 10 years. I actually started trading with forex. I started trading with forex initially, and then I moved off of it. Forex nowadays is it's too fast paced. You need proper robots and automated trading.
If you're
Yeah, you need automated.
You got to almost be up in the middle of the night.
Yeah, and then it's just, yeah, there's a lot that you need to handle there. With futures, you can control a lot. Like you can trade oil and and it's better leverage. It's better. You get more for less at futures than forex. So why not? Russell, I'd be happy to connect with you. Again, here's my email. Shoot me an email. We'll hop on a call, and yeah, whatever I can do to help.
Well, that's the thing. It's interesting. I'm taking a look at the comments, and you really have, there's, I think, 3 different types of investors on here. There's the investor that just puts money into what they've been told to put money into, 401k, 403b, save, and just kind of do what they know or don't know, but they just think the best thing to do is just keep saving. You have the other investor that is the one that doesn't want to know all this, but is looking for an alternative way to invest their money and looking for a safer way to do it, which definitely that's mine and Steven's language, and Sodi's as well. I've largely taken my eye off of the markets. I mean, partly because I have Sodi who trades the accounts, but I could still trade my personal account. I used to have a lot of fun with that. When I created 1010, during the pandemic, I literally wrote that entire course, off of stuff that I learned as an advisor, stuff I learned when I went to trade school for options trading. And I used to love doing it. And then I just got, after the pandemic, after it V'd, I just got sick of it because nothing made sense. And I really kind of did a big pivot in my investing life. I stopped investing. I looked for places where I could hide money and store money that would just be okay during this. I did a lot of research, and I arrived at 20+ year treasury bonds. I've talked about that a lot. I have a large position, and I think Sodi would probably be like, that's stupid, but I have a large position in I have 20+ year treasury bonds, and then I have 0 coupon 30-year bonds, which are about the most boring investment you can put money in. But there's one thing I understand, and one thing advisors should all know, because they all learned this in the Series 7 stockbroker exam, is the inverse relationship to interest rates. There's 2 things that you can't argue. Number 1, interest rates are going up. Nobody in this country can argue that that's happening right now. And if they do argue it, where have they been? They've been spending way too much time at the bar. Interest rates are going up. And when interest rates go up, doesn't take a genius to know that bond prices go down. It's been happening. Look at really any bond, but primarily treasury bonds. They've all been going down, 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 which is exactly what I love, because that's what I want to buy. Assets that are going down, down, down. And it's like, it's just clockwork. Interest rate goes up, bond goes down, buy. So I just keep buying, and I'm losing. My positions are at a loss with treasury bonds, but that's okay. I don't know where the bottom is. And any of you that are out there searching for the top or searching for the bottom, I have bad news for you. You will fail. Sodi will fail. He's not trying to do it, but he would fail. I'll fail. Ray Dalio will fail. Warren Buffett will fail. You can't find the top and you can't find the bottom. Cannot time the market. So the smartest way to do it is just dollar cost average in to something you know, like, and understand. I do that with treasury bonds, because then I know that, like Sodi just very elegantly, if I could spit that out, explain to you, there is an end in sight. There is a storm coming, and we just don't know when. Could be this year, could be next year. When it hits, it's going to suck. It's going to be like nothing any of us have ever seen. And that should frighten you, but that should also motivate you, because if it's going to be something that none of us have ever seen, if it's going to be that bad, in that exact quote lies a massive opportunity. I see the opportunity. Steven sees the opportunity. Sodi, we've talked about this many times, about the opportunity that will be presented in this catastrophic financial situation that's about to hit us. Because when one person's selling, another person's buying. When one person's losing, another person's gaining. I'm hiding in treasury bonds, and I'm stuffing a shit ton of money into my stupid, specially designed and engineered whole life plans. And then I lend that money through Private Money Club. But back to treasuries, as the price goes down, I keep buying, buying, buying. When this event happens, I guarantee you the Fed will drop interest rates to close to zero. Nobody has questioned why the Fed has to raise interest rates 7 times in a given year, have they? Has any of you just like sat back and just said, wonder why they got to do it so many times? Oh, it must be that inflation thing. You know, look over here, folks, look over here. And then behind the curtain, just like, so many of the movies, behind the curtain, this is going on. Look over here, though. We're raising interest rates to curb inflation. Yeah, there's some truth in that, and it will slow inflation down. But why else do you think the Fed is trying to get rates up so fast? Well, Yellen let the cat out of the bag. We got that one wrong. But she's talking about inflation. Oh, we got the inflation thing wrong. What she's secretly saying is we're going to get interest rates up because we know we're going to create a massive financial collapse. Recession, depression, whatever you want to call it. And when that happens, we got to have that ammunition in the gun. We got to be, that's a bad word these days, but we got to be able to pull the lever. That lever's interest rates. They got to get rates up so they can pull them back down. And when they do that, one thing every advisor should know and should understand when you have this discussion is all treasury bonds will have an inverse relationship to the Fed dropping interest rates, and they go down way quicker than they go up, and your treasury bonds price will skyrocket. And all you need to do then is just go collect. It's like, it's like Monopoly. Just collect rent. Rent is in the form of selling your bonds and collect that big gain. And then you're sitting on all this cash, which you don't really want. You start deploying it. And at that point, everything will be so beat up. Just pick an industry you love and just buy stocks. Find lenders that need money. People that are going to start buying real estate, because that's certainly going to go down in price. And deploy it in real estate. Like, we've been talking about this far too long. It's like a broken record, but yet, I was looking through some of the comments. Some people like, it's going to be a correction. Wrong. I don't mean to be a dick. This is not going to be a correction. Maybe in the near term, you've already seen a correction. You just saw an 8-week correction, and then it'll rebound. The end result of this, make no two ways about it, will not be a correction. And if that's what you believe, okay. Everybody can believe what they want, but I think you're going to be really sorry that was the decision you chose, because this will not be a correction. It will be a full-blown catastrophic collapse of to some magnitude. And when that happens, all you need to be is the one with the gold, and then you get to make the rules. Figuratively speaking, the man with the gold makes the rules. Like, gold can come in the form of, you got to have dollars, have money available in your privatized banking policies, sell those bonds and cash out and take all that money and then deploy it. The bonds will be one of the only places that are going to go up when everything falls. And that's why I hide out in them. It's boring. It's nothing fun like what Sodi talks about. Sodi's stuff is so exciting. Stuff I talk about is like boring. But you know what's not boring? Making money. I've never, ever found anybody that thought making money was boring. The only thing you got to decide is how fast you want to make it, or how much patience you have to wait for it. I just think all of you just need, to just be patient. We can't tell you exactly when it's going to go down. Sodi can't, Steven can't, I can't. We can't tell you what to invest in. Definitely never would anyway. If you get in with Sodi and you use this 10-10, the one beautiful thing is you're going to have a front row seat, literally front row, as to what trades he's making. And you saw his returns. They were like 300 and some %. How many of you want a small piece of that? Well, just get around his campfire, follow it, but don't take your eye off. Like, you gotta, some of those trades are intraday. They happen the same day. You got to be on it. But it's a great way to make a lot of money, and it doesn't matter if the market's moving up, down, sideways. Sodi will make more freaking money when the markets go down. This annoyance is what I'm going to call it for Sodi. That's going on in the market, this ping pong game of up, down. He hates that. Like, once he picks a direction, the man will make a lot of money. This is just a big disturbance and annoyance to him when the market can't pick a side. You're going to go up? No, we're going to go down. All right, you just got to find a direction. Are we going to go bull or are we going to go bear? Once we pick that side, he knows how to make a lot of money. And if you're following along with his trades and you're just watching what he's doing, which he puts out there openly to all of you, you make a ton of money. But that's the two investors. And then the last investor is really the investor that just kind of doesn't want to deal with any of this. And that's my favorite investor because that's the majority of you. You want to make money, you want to retire, you want your money problems to be solved, but you don't want to, trade Fibonacci, you don't want to trade, price movement. You don't even know what any of that shit means. You're just like, can I just do something super easy? Private Money Club was designed for you. The private funds we have are designed for you. It's just set it and forget it and get a check every single month. Like, I know a lot of people that love that. I do. And the older I get, the less I give a shit about Fibonacci, the less I care about all the technical indicators which have let me down so many times, the more I care about just give me a check. Can I walk out to my mailbox and get a check? Can I have Andrew go to the mailbox here and bring me back one of those little bill pays that you tear the 3 perforated edges off? Sorry, folks, that gets me fired up. Call it boring. It is what it is. But getting checks every day, and the more that they come, the more exciting it is. I don't like looking at a screen that bounces up and down every day, and I got to sit there and plan my entry and exit. You notice that Sodi had a plan. How many of you traders on here have a plan? I'm going to buy at this, and I'm going to sell at that. Because if you don't, that's where you start. And all of this stuff, we're going over it all today, but it seems like an hour and a half in these goes by quick. So the coolest part is July 29th for VIPs, July 30th and July 31st. Mark this down, folks. July 29th through the 31st. It's like, a little over a month away. You got plenty of time. You can come out here and you can spend 2 days or 2.5 days with us, face to face. And we're going to have some of the best speakers that I know of come out and teach you all these things that we just talked about. Like, you want to buy real estate? Well, let us show you how to do it the right way for this time, the right strategy to use right now. You just want those checks to show up every day? We got a bunch of people. You're concerned about paying too much in taxes? Well, we got 2 tax people coming in showing you some really cool things that you've never seen before. The one guy you've never heard from or seen, but what he teaches is phenomenal, and it's been being used for a very long period of time successfully. So I don't care if you're in real estate, you want to be, like Jim and some of the others on here, Russell, who are active traders, like we've got stuff there, or just people that just want to collect a check. We got you covered. Maybe you're somebody that kind of wants to blend the two of those. I can't remember who said it, Colleen or someone else said it. The best investment you can make is yourself. So spend the $297. Get your plane ticket. Stop complaining that airline prices are up. Of course they're up. Gas is like doubled or tripled or whatever it is. Of course airline flights are up, but they're still cheap. Get your flight. Come on out here and spend 2 days with us. You won't regret it. And I think they already put the links up. So, Sodi, what else do you want to talk about here? Some people mentioning the VIX. You hate my position, my VXX position. You hate that son of a bitch. But you think that I'll ever get that money back? I'm down like 68%, I think, right now. You think that's ever coming back?
Yeah, I think you will in due time. It's just, I hate the fact that it split, and that's where it cut it, because if it hadn't split, you'd be fine by now. It's split that kind of made it a little worse, but I'm not really worried about it. Just folks know the Wix wasn't created till a lot later. Okay, so the options came in the markets in the 70s or 80s, I believe, maybe 90s. So did the VIX. VIX is quite of a later creation. It's a volatility metric, but again, does it track truly? I don't know, but it gives us the most closest approximation of overall market volatility. And there's different products on VIX you can trade. And you can track it. You can track the VXX, you can track your VXY, things like that. But you have to be careful because at the end of the day, it is a volatility index. So there's spikes, there's drops, there's spikes, there's drops, and it's more about how uncertain the drop in the market was that causes a spike. So, but it's something that I use as a market sentiment indicator, but as a trading tool, it's not my favorite. I like to use it as a hedge. I think it's a better tool for a hedge than it is a trading instrument, just because of, when it works really well. And that's the time you want it to be in, because then the overall market is probably down quite bad. Just like 2020 was, I think, when it hit 80. And if you were just properly hedged with the VIX, you would have taken care of quite a few of your investments. So we have one more question here. What about an older person that probably has a 10-year window? I think the time horizon is less relevant than your risk appetite. If you are somebody who's, who's done what it needed to be done and is there, and your risk is very low, set it out, wait it out. Maybe once the top is there, try to get some short positions, protect yourself there, look for alternative investments. Because again, when the market like this crashes and comes to a halt and a reset, the other economic opportunities in other sectors will also be there. It's not going to be just a stock market that allows you to short. In real estate and other places, if you have cash, if you are willing to put in the time, I'm sure you'll find opportunities out there. And like there's so many opportunities I've heard Chris talk about in these webinars that I never knew about, and and sometimes my mind gets rolling. Oh wow, it's like this. Okay, what would happen if a crash happened, or what would happen if something else happened? So it's important to keep your eye out. So it's more based on your personal risk appetite and your preference of industry than that. Chris, there's a question for you.
Yeah, I see it from Patrick. Yep. So Patrick's asking, who should I contact to pay for help with clearing up my credit? And is the amount $350? I'm not sure the amount. So if you're talking about like your credit, like your credit score, probably corporate capital. I'll have Stephen put the number in there for that. I think that's what you're asking about. I don't know the amount. That sounds about right, depending on what credit you're looking to clear up. If it's your personal credit or you want to build business credit, corporate capital would be who I would send you over to. If you mean like paying off credit cards and all that, Stephen, could help you with that stuff, and our team of money mentors. And the other thing too, let me just lay this out while we've got everybody on here. There's something interesting we thought we'd be launching it today, but we're not. We're just not ready. We've got this thing called the Blueprint Strategy. We're going to be doing this. It's going to be $49 to go through the Blueprint Strategy, and it is something that we've never done. I don't think anyone's ever done it. It's going to be one of the most comprehensive, processes that you go through to really flush out where you're at, what you're doing, and whether or not it's right, and then giving you a direction as to exactly what your next steps are. Instead of us just guessing with things, we're going to find out everything that you want to have happen in your financial world, what you're currently doing, where the problems are, and then from there, the outcome will be one of 3 different things, which will then solve your problem. So we're going to be starting that, I'd say in the next week to 2 weeks. Okay, it's going to be called the Blueprint Process, and it's a whopping $49. And we got all sorts of trainings we're building for it, but the trainings aren't what you're paying the $49 for. They're just a bonus. You're paying the $49 literally to have this process and to walk through it with and we actually hired somebody specifically, 2 people we will be hiring for this, but one has already been hired to be the blueprint specialist. That's how much emphasis we're putting on this, because we feel like we do a really good job, but the one thing we kind of miss is there's so many people with so many different needs and goals. We don't know enough about you to basically make the proper recommendations. A lot of people want us to tell them how to solve all their problems on an hour-and-a-half long free webinar. Although we'll do our best, we can't always solve the problem that way, so we're creating a process for every one of you that's $49 to literally flush that out. And it's going to be something I think that's going to change the entire industry on how people help other people solve problems. Hopefully it's adopted. It needs to be, because it's the financial advisory world, I don't mean to be rude, is a completely flawed and failed model right now. It maybe has relevancy in some areas, but more of the relevancy today is just all about financial companies selling financial products that benefit and profit them. That's all it is, and that isn't benefiting you, I promise you. So those are some of the things that we're working on. Francisco said something that I think is interesting. You guys all have one choice. She's joking here, I want to be clear, but she said, can I just work for money for the rest of my life? Of course you can. You can do what you've been taught to do your entire life. You can go out there, trade your hours for dollars, and do that for the rest of your life. And I say that jokingly, but that really is what most people do. And it's sad, because that isn't what the wealthy do. That isn't what any of you should do. So we all are going to always work for money, because that's what we do to make money. But eventually, when you work for money, you follow the 6 laws of wealth, or you go through the process. What's going to happen is money's going to start working for you. Colleen said she got 2 checks just today that showed up in the mail. That's because of her money working for her. Now that sounds a lot more fun than going and trading hours for dollars, or working for money the rest of your life. So Francisco, thank you for putting that up. I know it was a joke, but it is important, because as much of a joke as that is, that's the majority of the people out there. That's what they're doing. And the other thing, too, I want to hit on real quick. Stephen kind of already hit this in the chat, and you guys can see it. But Russell was talking about 401ks, and I know a lot of you have 401ks. So if you're working for a company, one thing you could always ask them is you could always go to your HR or the plan administrator that runs your 401k and ask if they have a self-directed option or a self-directed, it's not true, I want to be clear, it's not a true self-directed, but what it would do is if your 401k has a basket of 15 mutual funds, of which probably 80% of them are those stupid retirement date or freedom funds as they call them, and then that's it, that's all you got. The self-directed option within a 401k, if your company has it, Vanguard sometimes is one that has it, Fidelity sometimes is one that has it, allows you to invest in individual stocks, individual ETFs, and kind of expand the horizon for the investments you can make. But they're all traditional investments, financial product investments that would be offered in any Wall Street firm. So check on that. But the one thing that you do not have the option of if you work for a company is a true self-directed 401k. So if you have an old, like if you worked at a company and you left that company and you've got an old 401k, an old TSP account, if you got an old 403b, 457 or 401k sitting out there, please get on the phone with us, because you really, really owe it to yourself to do what only 4% of Americans do, and that is get into a self-directed IRA custodian, or if you're self-employed, get into a self-directed solo K or a self-directed 401k, because now you can invest in anything. We had a call the other day, so do you'd like this. We were talking to a great couple, and we're just talking about they had accounts at the regular main brokerages, and we're going through it, and then they mentioned, well, we have a bunch of gold and silver too. And I'm like, oh, how did you, I thought that they bought it through their regular brokerage. I'm like, I've never heard of a regular brokerage account, and it was a Fidelity account, allowing you to buy actual gold and silver. So I thought they were mistaken. I thought they just had like that ETF that's GOLD. But they had physical gold, because then they said, no, we have it stored at this place, and this is how much we pay a month to store it. And I'm like, wait a second, Fidelity doesn't allow you to do that. They're, no, we had to move it to this company, which is a self-directed IRA, and then they use the money from their IRA to buy physical gold and silver, like Stephen talks about every Thursday at 3 p.m. And then they started saying, well, what else can we do? I introduced them to Private Money Club. And now what they're doing is they're actually lending on 2 deals, actually I think soon to be 3 deals in Private Money Club. Private Money Club's got all sorts of new deals. Like, it started as just this little pet project for me to be able to move my money, and then it's kind of morphed. And even though we haven't launched to the public, it seems like every day we're getting new people coming in. And now for the first time since I created it, or me and Stephen have been working on it, we actually have lots of new deals going up. We have a lot of money in there before, which then it created almost this like archaic thing where like the people with money were rushing to get the deals, and then there was no deals. Now there's a lot of deals on there. A deal just got posted from an investor. It's a great deal. It's 15% interest. It might already be filled, but there's lots of awesome opportunities on there, and there's going to be a lot more. I have an opportunity right now for a big 508 unit apartment complex that any accredited investors can get in on, and it pays 16%. And it's fully secured by this building. It's a great deal. There's all sorts of stuff like that. So you just got to get on the other side and start getting away from the traditional financial stuff and start learning what fits your needs and, like Sodi said, your risk tolerance. How much risk do you want to take, and what return do you want? Fill those 2 boxes and you'll be a lot happier, instead of trying to say, well, I don't really know what I'm investing in, but I'm super conservative. And then Sodi looks at your portfolio and he's like, you're super conservative? Well, that's funny, because you're heavily allocated to small and mid caps. You've got these alternative, tech stocks, which are down 60%. You're not conservative at all. But you didn't know, because you didn't invest in things you knew, liked, and understood. This isn't rocket science, folks. I don't care if it's treasuries, the ultimate, safe play. The privatized banking is a whole different world of just moving money and doing it with a couple 100-year-old system using giant mutually owned insurance companies. I mean, obviously, if you want to hear about that, Stephen does a training every single Tuesday night now. You can learn about that, but that's great. Or you just get on a plane, get your butt out here, and join us the 29th, 30th, and 31st. But I know some of you still like to do trainings in your underwear. I know a bunch of the people watching are in their underwear right now. So we do offer a virtual option for the July event, and you can just sit in your underwear and learn from us speaking on stage. But it's going to be a very different event. We've never done one like this. Matter of fact, Stephen, this is like our first live event we've done since the pandemic, since we got stuck in Disney that one time. So I urge all of you to really take advantage of that. And I urge all of you that are interested in trading to get with Sodi. It's very important that you start trading with some rules. And if you don't want to come up with your own rules, just get in his corner, get around Sodi's campfire, and he'll teach you how to do it. There we go. Chris is going to be driving to Buffalo for the July sessions. So Sodi, what else do you want to talk about? We got about 10 minutes left. What do we want to wrap this thing up with?
I think we covered quite a good amount of information today. If anybody has any other questions or things like that, that would be better to spend time on anything else that they want to see or ask about. But yeah, we'll have to do something very interesting for the in-person events.
Well, let's hit this one. Juan's asking a question, and I'm going to have Stephen answer this. Should I still put money in my Roth IRA?
Can't answer that for him, but yeah, I mean, it depends. I mean, if you have money left over that you're looking to stick into a tax qualified account and you're self-directing it, and that would help your overall investment strategy, then absolutely. If you're just starting a brand new Roth and there's not much in there, then there might not be a whole lot of reason to do that right now. But it's not really a yes or no answer. It's what's your overall plan look like? What's your overall strategy? And let's go from there with it.
Love it. Yeah, Roth IRAs have a lot of unique advantages from a tax standpoint, but remember, it's still a qualified retirement plan. And, if you're not in a self-directed Roth IRA, I think you can do one better on that. Stephen just put the link up, folks, for the July event. We only have a set amount of seats if you're coming to the live one, and it will sell out. VIP, I know we're probably down to about 10 seats left. So if you want to go to the ball game with us, sit in that 50s themed diner at the baseball field and chat and spend one-on-one time with us over a couple cocktails and some fireworks and a ball game, then you better grab those quick. Question.
Let me clarify a couple of things. So Mark, a couple people were asking about the replays. We do put these a couple days later. So probably like by Monday, if not Friday, it'll be on the YouTube channel. So I'll put it in the chat box, but it's youtube.com/the Chris Naugle. That's where we put all the wealth webinar replays. We do live streams there. Everything goes on there, as well as all the fun videos and more. So make sure you go over there. And while you're there, if you can hit the subscribe button and ring the little bell right there that subscribes you, that really helps us with algorithms and things. Remember, we do all of these trainings, 6 webinars live every single week for free. There's no charge. There's no membership involved. We put everything on the YouTube channel free of charge. So if you could help us out and go subscribe over there, that'd be really, really cool. So somebody's saying self-direct IRA means you control the trading. So what a self-directed IRA is an IRA is an IRA, whether it's self-directed, whether it's a Fidelity, whether it's at Morgan Stanley, whatever the case is. An IRA just means it's qualified funds, meaning the IRS gives you special tax qualifications for the money you're investing if you follow the rules involved with either a traditional IRA or a Roth IRA. Now, all self-directed means is that you're with a broker or a custodian where your IRA is that allows you to invest in things outside of the stock market. So for example, Fidelity IRA is going to let you pick stocks, mutual funds, indexes, bonds. So they might let you invest in that kind of thing. A self-directed custodian is going to allow you to invest in almost everything else. So you can buy real estate, you can do private money lending, you can invest in startup companies, you can buy, like we were talking about, physical gold and silver. You can't invest in like collectibles and a couple other little things like that. But for the most part, you can invest in almost everything else. So that's all self-directing means. It's all the same tax qualifications. And what you have the ability to do is if you have old 401ks from old jobs, or you have IRAs at Fidelity and places like that, you can consolidate and move those, transfer those over to a self-directed custodian. There's no penalties, there's no fees, there's no taxes that are caused by doing that transfer. You're just taking back control of those retirement funds. And instead of being forced to invest into the stock market, the stuff we've been talking about for the last 90 minutes that I don't understand at all, you can invest in things that you do understand. If you're like me, things like real estate and precious metals and private lending. So that's what self-directed investing is. And we have an incredible partnership with a company, Horizon Trust Company. That's a custodian that does self-directed IRAs. So if you're interested in learning more about that and getting one of those set up, I can go over the different options because we give you full support. So we help you move the money. We show you how the money's going to move and what that plan looks like. And we give you access to things like the Private Money Club or the crypto investing courses, part of your self-directed package. So I can send those over to you guys. So if anybody's interested, just email me and I'll get a call set up, or I can send you over that info and we can help you guys get started.
Love it. So we just put up the link for Private Money Club. If any of you are interested in getting in there, you're down to the last couple months where you can actually lock in a 1-year membership for $997, because in October we go public. We're doing a live launch. Many of you that are part of the 25-25-25 will join us in Utah for an epic once-in-a-lifetime event where we launch Private Money Club to, I'll say the world, but really just US-based first. And we're going to do it that night, but it's going to go up in price. It's going to be $14.97 after launch. So you guys want to get into Private Money Club, get it in there while the getting's good and while it's still not offered to the public. This is your only way into Private Money Club. And also, people were asking about the 3-day event that we're doing. Well, it's not really 3. It's the Money School event we're doing live. You can also do it virtually, just like we always do the virtual. We'll be streaming virtual and live. We rented a movie studio, so it's a really cool setup. It's going to be theater-style seating, and then you're literally going to be looking down on a movie set or like a TV show set. Think of like David Letterman or that. And we're having custom things built for the backdrop. It'll be a really different kind of event. You won't be shoved in a stuffy hotel. The movie studio is right next to our offices. So we're going to be bouncing back from the Money School offices here, which is 8,000 square feet, over to the movie studio and then back here. And then we're even going to do a networking party, which we just locked in with a really cool restaurant bar here at the mall. So it's going to be an action-packed day. Make sure you get plenty of sleep the night before because it's going to be a lot of fun. Larissa said here in the questions, when I become the bank of me, then where does all my money and everybody else's money physically go? So when you're your own bank, remember you're using a specially designed and engineered whole life with a mutually owned insurance company that pays dividends. So your deposits don't sit in a regular traditional bank. They get moved over to a giant mutually owned insurance company, of which then you take money out from there to do different investments and different things. We have a great video at chrisnaugle.com. You just go to chrisnaugle.com, watch the video, and it really explains that. And then after that, just set up a call with somebody on our team, and we can answer all your questions. But it does not stay in traditional banks. We still use traditional banks, but to a very minor capacity and only really for transitioning money from your private bank to whatever investments you're doing or whatever you're going to do with it. No, we do not teach you to keep money under your mattress in your bed. That happened in the Great Depression, and you're not going to have us talking about that anymore. And let's see. I do very high quality art. How can I invest in that? I don't know anything about high quality art, so I don't know how to tell you to invest in that. But I don't think you can buy art with your self-directed IRA, can you?
No.
Yeah. So you just have to do it with money in the bank or money under your mattress, Patrick. That's how you'd handle that. So folks, this is a lot of stuff we just covered. We really hit a lot of topics. Julie, I know you're asking, a lifetime fee for Private Money Club. There is no lifetime fee unless you're part of 25-25-25. So the fortunate ones were the people that got in as original investors. We only took on 25 of them, and they're the only ones that will ever get a lifetime entrance into Private Money Club. So other than that, it's just an annual renewable subscription, and probably one of the greatest things I've ever created. And with a lot of help, we're still creating it. Me, Steven, and the entire team here. It's our pride and joy, and it's just incredible how it's working. It really is helping so many people, and hopefully the camera's working. Well, actually, Patrick, we hired the TV studio and the people that work the cameras to do that, so that I don't have to mess with any technology at all. They do it all because that's what they do day in and day out. With that being said, folks, listen. Sodi's going to put his contact up so that you guys can get in on that. If you're interested with Sodi, make sure you contact him, get on the phone. He will actually get on the phone with you and talk to you about the different services he offers through 1010 Trading. If you're interested in the July event, whether you just want to come to it virtually or you actually want to physically come out, shake some hands, give some hugs, and do all that good stuff, well, the link will be up in just a second. And lastly, if you are interested in the private private money club, we put that link up, or money multiplier. You just got to watch a 90-minute video, book a call with us, and then we'll help you solve that. So that's pretty much a wrap for today. You know, we wanted to finish right on time. I hope you guys enjoyed this. I know I started a little bit late, and that was totally on me. And I just want to make sure we gave you lots of value. And I think Sodi really dropped some golden nuggets. So thank you so much, Sodi, for joining us today.
Absolutely. Always a pleasure.
And I'm sure there's a lot of really good stuff. You guys, if you are traders or interested in that, please do yourself a favor. Get around this genius mind. As much as I say we differ in opinion in that, we really don't. Like today I was listening to him and I'm like, yep, check, yep, check, yep, check. He's just more optimistic. He does this every single day. Me, I'm sort of just like, all right, I don't want anything to do with what's coming. So for me, I'm just gonna hide out. I'm gonna do my little stupid boring treasuries and my stupid boring infinite banking concept, and I'm just gonna lend money out, but it's all for good fun. Every one of you have to pick things that you know, like, and understand and go deep into them. And I think that's some of the best advice that you all can get. So hopefully we'll meet a lot of you at the 3-day. And other than that, I'll see a lot of you on Private Money Club, I'm sure, where we're always on that, always chatting with people. But other than that, folks, have a great day. Stephen, anything you want to say before we close out?
No, I love it. Just give me a shout if I can help anybody with anything except for the stock stuff.
Awesome. Yeah, except for the stop stuff. I want nothing to do with that. I go to Sodi for that. Every time Sodi talks to anyone on my team, they just sit back and they're just like, wow. It's like watching the new episodes of Stranger Things, right? You just sit there and you're just like, whoa. All right. With that being said, folks, thank you all for joining us. We appreciate you spending a little bit of your afternoon with us, and we will see you this afternoon at 4:30 for the happy hour, Ask Me Anything, where we'll answer any and all questions that you give to us. And you can get there by just going to my YouTube channel at The Chris Naugle. Register on that. And, just to register, you just subscribe and it'll pop up. Or any of our Facebook groups, from the Infinite Banking Group, How to Flip Houses, or any of my Facebook pages. That's how you get on there. Till then, we'll see you next time. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.